Hey everyone, while I was moving into a new apartment this week, I got the opportunity to check out some stock market content on some other channels, and it honestly scares me some of the investing strategies that are being broadcast to hundreds of thousands of people. So in today's video, I'm going to be breaking down the most common investing strategy that I see people talking about, which is to buy stocks on red days. I'm also going to provide you with two very clear examples as to why this strategy makes absolutely no sense, as well as talk about a theory that I have that suggests that this may be a misinterpretation of a famous investing quote, which is leading people to think that buying stocks on red days is a smart way to invest. Make sure you stick around to the end in this one, because the purpose of this video is not just to help you to avoid one of the more common investing traps, but also hopefully to set you on the right path as to what you should be doing when you are investing and making long-term investments in the stock market. So the core of this common strategy is that you want to be buying the stocks of great businesses on red days, on days where those stocks have gone down in price.
So here's my strategy. Borrow as much money as I could safely. And again, I'll break down how I borrowed it. And then every day the stock market was red, I would buy my favorite companies. If it was a green day, I would not buy. If it was red, it was a day to buy.
And the first part of this strategy, I generally agree with. We want to be finding a short list, a list of a couple of businesses that we've thoroughly analyzed in one way or another to determine that it will be a great business that can thrive over the long term. And of course, everyone has their own way about determining whether a business is a great business that would be then worthy of an investment. The way that I teach it on this channel is to talk about the core of Warren Buffett's principles. So this basically breaks down into three distinct categories. First, we have circle of competence, which is where we are making sure that we deeply understand the businesses that we're investing in. The second component is competitive advantages, or as Warren Buffett would call it, an economic moat. So making sure that the business has something distinct, something unique over its competition that will allow it to thrive over the long term. And the third component is to assess the people who are managing the company. So it's not enough for you to deeply understand the business and for it to have a product or a service that is unique over the competition. We need to think about and look at the people who are making internal decisions about what products to launch and what marketing to do and so on and so forth. So we need to assess the people in power, how skillful are they at their job, and then also, are they being honest and transparent with us in their communications to the shareholders? And then, of course, once you have a list of great businesses that you're ready to invest into, you need to know how to go about making those buying decisions. And this is where I distinctly think that buying on red days, just buying the stocks of great businesses on days where their stock has gone down, is a terrible idea. But nevertheless, you will see tons of people creating content on YouTube talking about how they find great businesses, and then if that stock goes down 3 or 4% that day, they will be buying more of it simply because the stock went down 3 or 4 or 5%. Now, I just want to go through two examples, two kind of thought experiments to display to you, to show you that buying on days where stocks go down, or in the inverse, avoiding buying a business because it's gone up that day, why that makes absolutely no sense. So let's take stock A, for example, and let's say that its current stock price, or its stock price yesterday, for example, was $100 per share. And let's also say that we have a crystal ball and we can see that this business is going to deliver $50 per share in returns to shareholders over its remaining life. Okay, so its current price is $100. That is what you would have to outlay today, and you would get back over its remaining life $50 per share. Now, if that business goes down to $98 per share, it goes down 2%. Would you be willing to invest in that company? That's the question that you want to ask yourself. And I hope that the answer you have is no, because it doesn't matter if the stock is 100 or 98. It has to be less than the amount that it's going to deliver to you in returns over its remaining life for you to care about investing in that business. So then the second example that I wanted to talk about was, let's say again, we have a business that's share price is $100 per share, but instead of it being able to deliver us $50 per share over its remaining life, it can deliver us $500 per share. Now, ask yourself this: if the stock went from $100 to $102 per share, would you avoid buying that business? Would you hold back from investing in that company because it went from 100 to 102? And again, I hope the answer is no, because if you can buy a business that you are confident can deliver you $500 per share over its remaining life, and you can pay $100 or $102 per share, that could be a very, very good investment that could deliver you a very, very good return. Now, of course, in reality, we don't have a crystal ball where we can 100% exactly pinpoint how much cash we're going to get out of a business, but the examples still are relevant because it shows us that the price movement of a stock, the movement of a business on a day, whether it goes up or down, should not come into your investing decision. What should come into your investing decision is comparing what the price is that you can pay today for that business to what it can deliver to you, what it can return to you in the future. And even though we can't shake a crystal ball and figure out exactly what that number is, we can, through thorough analysis, come up with an estimate of a reasonable amount that we can expect to get back from that business, and therefore a price that we would be willing to pay. Now, as I mentioned earlier, I have a theory about why this strategy is so widely spoken about and so widely used. And I think it is because people are misinterpreting a famous quote from a famous investor, Warren Buffett. So there's this famous quote from Warren Buffett that says, "Be greedy when others are fearful and fearful when others are greedy." And I think that people are misinterpreting this to believe that you should be buying on red days and not buying on green days. And that is a distinct misinterpretation of this quote, because what Warren Buffett actually means when he says, "Be greedy when others are fearful," is that he says you should buy businesses only when they're undervalued. Not when a business has one red day, but when it's been going down for such a long time that there is a distinct gap between what the actual value of that business is, what it can deliver to you, compared to its price. Remember that business that we spoke about earlier that was $100 per share, but it could deliver to us $500 per share? That's a distinct gap between what it's actually worth to us, because ultimately what it's worth to us is what it can deliver to us. So if that business can deliver us $500 per share over its remaining life, that's what it's worth to us. It's got a value of $500. Then there is a distinct gap between the value of that business and the price that we can pay. And that means that people are fearful of that business, and it means that you should be greedy if it's a great business, if it meets our requirements, and you can purchase it at a price that is distinctly undervalued.
The value of American business depends on how much it delivers in cash to its owners over between now and Judgment Day, and I don't think it changes in 10% in a 2-month period if you're looking at it as a business. Now you've got, if I'm going to buy a half interest in a McDonald's stand and you're going to run it, or McDonald's franchise, and you're going to run it, I look to the business to determine whether I made a good investment. And I'm concerned about, whether we have new competition, how we do over the years, but it's the business I look at. When you're just looking at the price of something, you're not investing. I mean,
Now, I don't want anybody to misinterpret what I'm saying here, so I want to make this clear. I'm not saying that you should never buy on a red day. What I'm saying is that you should not buy because it's a red day. You should be buying because you have done a thorough analysis of a business, you found that it's a great business, you've come up with a reasonable estimation of what it can deliver to you in returns over its remaining life or over the next 5 or 10 years or whatever kind of analysis you do. And you should be buying that business because it can deliver to you far more returns than you have to outlay today. Not because the business went down 1 or 2% on a given day. And it also means that even if a stock goes up on a given day, its price could still be undervalued. It could still be at a price that can deliver you abnormal returns, 10, 12, 15% returns over the next 10 years. Oh, and one more thing, if you've been watching this video and you're thinking, yeah, that all sounds great, but I don't know how to analyze businesses. Well, the best thing that you can do is hit subscribe so that you stay up to date with all of the upcoming videos, as well as head over to my channel and check out a playlist that I created called 4-step stock analysis. This goes through the 4 key Warren Buffett principles of fundamental long-term analysis, and you can go through, there's maybe 15 or 16 videos in there for a couple of hours that will break down each of the components of the process that is based in Warren Buffett's principles, the way that he's been able to find great companies and purchase them at appropriate prices. And of course, as always, if you enjoyed this video and you want to see more content like this, then make sure you let me know by hitting the like button. And of course, as always, let me know your thoughts down in the comment section below, and I'll be answering questions as this video goes live. But for now, I hope you guys have a great day, and I'll see you in the next video.